Welcome to IVoT Eye On Investing, where our experts look at the economy, the market, and particular companies from a long-term fundamental perspective. IVoT Financial Training Inc. is a company committed to making financial mastery accessible to everyone. To learn more, go to ivot.academy. My name is Emile Westergaard, and I am the founder of IVoT. I spent 20 years as a professional investor and believe that understanding how to analyze and value investments is a core life skill that needs to be learned to be effective in the modern global economy. Today, Andrew Tang, our IVoT expert market analyst, walks through the latest economic data, including increasing unemployment and what it means for the economy and second half outlook for the market. Next, I walk through updates of SBUX, Apple, and Pfizer based on recent reported results from a fundamental perspective, using the IVoT Forecaster, our proprietary tool for performing fundamental analysis and forecasting on public companies. In particular, we look at how the new CEO of SBUX, Brian Nichols, is progressing with his turnaround strategy, how Apple is shifting from a product company with services to a services company with products, and what that means for future sales and margins. And finally, at Pfizer, which looks incredibly cheap, but is facing patent expirations on half of its revenues over the next 3 years. Let's get started. Welcome everyone to today's show, and I'm here with Andrew Tang, who's traveling in Southeast Asia, I guess, right? It is Kuala Lumpur right now, headed to Singapore. How just tell us a bit. What are you doing in Asia? How's that? What's that trip all about?
Yeah, it's trying to spend some time with family, and then this echoes alongside with many people in my industry, taking the summer off. And for many years, I stayed behind and work in the US hours, market hours, and then my family would go to Asia to visit her side of the family, and so on and so forth. So this year, I decided to work it out and tag along, and then work on US hours and still try to participate in the daytime activities.
So it's 10:30 at night for you, and me in Lima, it's whatever it's 9. It's I guess when 9:30 here, I think. Anyway, yeah.
Yeah.
Cool. I guess we start out usually with any kind of update on what you're telling your clients at this point. How are things? How are they feeling about things? Have they been benefiting from this, strong market over the last kind of 3 to 4 months? And are they happy with things? And what are you telling them?
Yeah, we're getting a lot of feedback from clients that they really don't know where they're heading. And from the previous communications that we sent out to our clients is that we are seeing the S&P 500. I'm just going to use that index for the broader stock market. The S&P 500 is rolling over. It's in motion. And we can break out of it and achieve new high, of course, we could. But we are in the midst of the lazy month of August, the summer. So a lot of the decision makers for hedge funds and institutions, they are taking advantage of the summer while the kids are off from school. And I expect this to be a sleepy August. And the stock market should consolidate to some level. We're calling it less than 10% of a sell-off, and most likely the market is going to trade sideways until the September FOMC meeting for the U.S. rate cut decision is finalized. Yeah.
So basically, that's the message to your clients, and I guess kind of your view of the markets right now, right? I mean, basically, we've got a bunch.
Correct.
Go ahead.
So I'm sorry. Yeah. So for investors that are invested already, there's no need to pull out of the market because this is a consolidation, a temporary sell-off.
Right.
So that most of our clients, they have much lower cost basis. And that's always the idea, is to start investing and then build up the cost basis or the gains or unrealized gains in your portfolio, so much so they can withstand the volatility. But for new cash that are deploying into the portfolio, we're actually staying put and temporarily putting into low beta bucket first, and also for the equity portion, we're putting into money market until we get a buy signal. One of the indicators that we pay attention to, and I'll put it on the screen right here, is called the spread indicator. The spread indicator really shows that we have nowhere to go but sideways. And until that reverses, it's not going to open up for the market to to participate too much on the upside. If you look at the chart, I'll put that up here. You can see that the rolling over motion, it's already started, and it is likely to continue. And again, fundamentally speaking, you can say that the earnings have been good. Economy still has been strong. But after the jobs data that came out for July, obviously that was a big surprise as to, hey, how come we revised down so much so? So turns out that we need to develop a newer way to collect data for employment and from BLS. And so we do anticipate better ways for us to get better data going forward. And today's CPI number, inflation number, just came out, which is better than expected because most have anticipated that we will get much more of a jump in inflation due to the tariff uncertainty. But it seems to be that side of the effect, you can call that the negative side effect of tariffs, it really hasn't happened yet to the consumer level. So what that tells us is that, one, perhaps that we are still burning the existing inventory that Q1 has pushed for so much so that we're still working on that. Or secondly, is that the businesses and the distributors, they're figuring it out. They're figuring out on how to absorb this so that they don't have to pass on to the clients. Because it is always the last resort for businesses to pass on to their clients.
Yeah, definitely. Well, and obviously they have other aspects of their businesses that have been working in their favor. So generally margins, I think, have been strong for the last couple of years. So they have probably some firepower in their pockets to deal with this issue. Yeah. Well, that's great. Well, maybe we'll segue then, into the fundamental side of things. I mean, again, just to reiterate to everyone, our focus here is on long-term investing, long-term fundamental investing. So generally speaking, and I'm sure Andrew probably would agree, you want to just put a certain amount of money into the market every month, and in that way, not worry about the ups and downs so much. But I think it's important to know what's going on in the world, and Andrew does obviously a great job of framing things, so that we can understand what we own when we own the global economy. In this case, now our stocks for this week are StarBucks, which is a fundamental teaching stock that we have at IVoT. So when you come on our platform, we actually teach you how to value companies using first a single coffee shop and then expanding that to Starbucks, which is simply 40,000 coffee shops or so. So we'll talk about Starbucks and how that business is doing right now, and fundamentally how that compares to the stock price. And then we also will then move on to Apple and Pfizer. So I'm going to try to be pretty, tight on this. I have some notes here, and I will pull up the tool. So let's just go to the tool and talk from the tool, the IVoT Forecaster for each of these companies. I've got it here somewhere. Come on, Emile. All right. So we'll start with Starbucks. So basically, Starbucks is essentially flat year to date. It's traded anywhere between, as low as 80, as high as 115. They just reported their fiscal third quarter, ended in July. Their cash flows you can see here, and there's a lot of numbers on this screen, but this one's important. The operating cash flow declined by 25% in the quarter, which is, terrible. And the stock has actually responded pretty well to that. The stock's up. So there is a general view that the CEO is doing the right things despite the decline in cash flow. Where you can see that the intrinsic value based on that cash flow, according to the IVoT method, is $93 baseline right now. That's down from $126 a year ago. That's down 25%. It's all based on cash flow, right? When you own a company, you own the cash flow. Now, what drove that decline? They actually increased sales. So it wasn't sales. They grew sales, not great, but 4%, not bad globally. However, their operating margins fell off a cliff. Their operating margin went to 9.5%, down from 15.8% a year ago. Again, just in plain English, that means they're making 9.5 cents of profit for every dollar of sales, down from 15.8 cents for every dollar of sales of coffee or whatever they're selling around the world. And that's not good. Now, the explanation for that from Brian Nichols, the CEO, the savior, as you might call him, from Chipotle, who came in about 7 or 8 months ago, had to do with a significant investment going on in their Back to Starbucks campaign. So they're, in terms of employees, training, infrastructure. Now, that's great. The market's buying it, meaning that market didn't just take this thing to town based on this decline in cash flow. However, I do think, we're hitting a point now where this, Brian's going to have to show some improvement in the numbers. I mean, again, in the end, it is a cash flow vehicle. That's all it is. And so we have to see that the margins are going to be improving and that things are going to be getting better. Now, if we were to, again, grow this business, he needs to get to 10% growth to be a rock star. And he needs to get this thing probably, get margins back under control, let's say back to 76%. You can see that would bring you to a quarterly cash flow run rate of roughly $2 billion at $164 price target. So if you're a believer in Brian Nichols and the strategy he's pursuing, then it's interesting. You're paying par right now, right? Right now it's worth 93 on cash flow and you're paying 93. So you got to believe in the strategy that Brian's pursuing. Let's stop for a minute. And Andrew, why don't you just give us your thoughts? We can talk about that for a minute.
Yes, what I think is going on with Starbucks right now is that Brian's strategy is trying to improve efficiency, but also he's trying to change things up a little bit, so from removing the pickup orders only from the app to creating a community type of environment, it's tricky at the same time. The company is trying to improve efficiency by, taking advantage of AI and also the tech stack. But at the same time, it's a struggle because it is very difficult to embrace a premium brand when you are really forced to, reduce your cost. And labor cost is continuously going up, and also we don't make coffee beans. Most coffee beans are really secured by overseas, and for Starbucks to ship their own coffee beans from out of country back to the US to process, I don't know if they have to pay tariffs or not. This is a very tricky question. But they did appoint a new person to the board, which is the next CEO of Yahoo, by the name of Melissa Mayer. So there are improvements that are to be made, and the results are still remain to be seen here at Starbucks. So it's really up to, it's really, the results are still remaining to be seen, so to speak. So we don't know. This is still a toss-up.
Well, yeah, we have a level 2 modeling system in IVoT, which would look more at the product versus the store expenses, right? They break out their expenses basically into store operations and then into product and distribution. And it'd be interesting to see where the increase in costs is happening. That would be in the level 2 model. And I might start doing a series of little kind of 20-minute shows on one stock where we just kind of go in more detail. And of course, Andrew, you're welcome to join me for any of those. But I think, the other thing you could say
because we know that companies can do this, is they kind of want to set themselves up for success. So a company can load up expenses into the current quarter, do a lot of spending so that they look out over the next 12 months and they have very easy comps and they can make themselves look really good. So I think we're now on the, I think this is actually the fourth quarter since Brian joined. So I think he's heading into his second year and he's looking at 4 quarters of hopefully this is the last tough comp he had. And now he's walking into 4 easy comps, 4 bad quarters to announce earnings against. So on that level, you could see kind of that he loaded up this quarter with all kinds of spending so that he could have a great run for the next 4 quarters, given again his options and all the options they've probably been issuing to the management team during this kind of tough period of their business. So that's my experience as a fund manager looking at companies going through you might call it a restructuring. And this might be actually an interesting moment
Yeah.
to
Yeah. Don't forget that, we still have a huge divergence of confidence level. So remember, investor confidence is all-time high, but consumer confidence is all-time low. Don't forget. People are still very worried about the negative effects of AI, and you can see that there are many efforts out there to try to promote the idea that AI is going to create more jobs than slashing, jobs across the board. That is still an idea that needs to be sold to America, and America needs to believe it. But until then, there's going to be integration. There's going to be change that it's necessary to the workforce and also to the skill set of what's required for the current and the future workforce. So all these changes are happening at the same time. I think consumers are spending less on discretionary spending, and Starbucks is on top of it.
Well, that's
And
the
then
thing. I
that's
mean, he
why,
can do all he wants in terms of strategy, but
yeah,
if he's walking into a shitstorm in consumer spending, to your point, I mean, I don't know. I think we should do a whole show on AI's impact on employment from top to bottom, right? What does it mean for the high end of employment, the middle end, and the low end? Because
I have so much to talk about that with you, Emile, and I think our audience will greatly benefit from that. So go ahead, please comment below if you feel that if we are going to do, let's say, if we propose to do a whole full episode just on AI and what it means for future jobs, and then what should college graduates or what should college student should think about, and before they choose a major, for example, we can talk about all that. So please comment below. Your feedback is always welcome and appreciated.
great. Okay, so let's move on to Apple. And again, I'll try to be relatively, high level here, but hit some key points. So the Apple Forecaster, excuse me here, not that one. Here we go. Okay, so wrong page. And again, all these tools are being built into the new platform. So you won't be getting Excel spreadsheets as a member. You'll be getting actual tools. But we are in construction mode at the moment, final construction mode. So you can see, again, a little simpler view here. Apple grew cash flow 10% in their fiscal third quarter. Their intrinsic value, baseline value right now is $171 versus a $227 trading price. So you're paying a 25% premium to the cash flow value. However, you can see that because cash flow grew at 10%, the actual value of the company increased from 153 to 171. So, again, just to remind everyone, when you own a share of the company, you own it forever. You're buying the future. And in this case, the question is, what is Apple going to be worth in the future? The way IVoT looks at the future is 3 years. That's why you can see it. Q3 2028. What's it going to look like then? And we can throw it in here. If they can continue to grow at 10%, that would be 221, still not a buy. They would need margins to increase, which let's just say that happens on the gross profit line, and this goes to 42. And I'll talk about that in a second. Oh, sorry, I hit the wrong number. It did. Okay, if I take this down, sorry, to, let's call this 48. That's a big increase in gross profit. That goes from 46 to 52. That gets you to a $257 stock in 3 years, 10% compound sales growth, and an improvement in margins by 500 basis points. You know, I got to tell you that from my perspective means the stock looks a bit expensive, if that's what needs to happen. Obviously, if things go better than that, then that's a whole nother thing. They're sitting on a massive amount of cash as usual. So it's also a matter of what they do with their cash. I think the other thing I want to say, and then I'll stop, and is there is a fundamental shift going on in their business. They are now almost 50% of their revenues is coming from services. They're moving from a product company, phones and computers and wearables and whatever, to actually being more driven by the services that they sell behind all those products, which from a investor perspective is a good thing. They make us, they make a 75% margin, gross profit margin on their services. They make a roughly 35% margin on their products. So as the that's why putting that 500 basis point shift in margins over the next 5 years is not out of possibility, given the shift and the continued shift towards their higher margin services business. I think one of the things you and I have talked about a bit is how is AI going to be a part of that, and how are they going to use AI to drive more revenues through their existing install base of products.
Yeah, and I think that's a perfect segue into naming the challenges that Apple is facing right now. I think most of the analysts on the street, as well as the users like you and I, as well as customers within that ecosystem, still value the brand very much. And the customers so far up to this point, they're still willing to be more patient with Apple. For example, I purchased the Apple 16 Pro Max with the understanding that there's going to be more AI capabilities to be delivered, but they have disappointed. But at the same time, is that so bad so that's going to make me switch brand? And the answer is no. The answer is no. They have built such a strong brand loyalty customers that when you're within this Apple ecosystem, you are very unlikely going to switch. Okay, you're very unlikely going to switch. Now, if you're one of those tech-savvy guys that wants an amazing, let's say, fold-up screen that the Asian phones has, I am in Asia right now, and I'm seeing that. That's a different story, because I see that Apple users, it's only a small percentage in Asia. Okay, most people they use other phones. Okay, and they seem to have no issues with securities and all that. Like, they don't really pay much attention to it. Tell you the truth, that's at a consumer level. Now, going back to Apple, is that even with the disappointment with AI delivery, we still believe that this is a monster cash cow that's out there. And the reason why, no matter who is going to be the winner with the AI app, as long as it is compatible on the Apple iPhone platform, it will be there, it will deliver, and it will pay 30% to Apple no matter what and no matter who the players are. So at the end of the day, this is still a monster cash cow that don't overlook it, don't underestimate it. Apple will be okay.
Yeah, I think it makes sense. And to your point, product sales in the quarter were actually reasonably strong. The margins on the products were not. They were down year over year pretty nicely. And I think goes back, though, to the fact that if they're making a huge amount, if they're growing their services on these products high, they can actually have a little bit more give in their pricing because they really want the revenues off of the install base. So
Yeah. The question becomes, does Apple want to internalize to have their own AI? Do they, of course, they want to have their own data. But let's say, if other platforms like OpenAI's ChatGPT or even Meta's Llama, Anthropic, do they want to use that and collaborate with Apple and be on the platform and have that launch instead? Well, it really depends, because right now existing Apple users or iPhone users, they're using ChatGPT, they're using Grok, they're using Llama because they're
Yeah.
all available, as an app. And they pay 30% of whatever the revenues come through the app. So again, it's still a win situation for Apple. You can look at it with many different ways, but do they really need ownership? Or you don't have to be first to market, right? You can, just wait and see when things develop or the AI landscape develop into a much more efficient way. Then Apple will come up with a acquisition. I have no doubt about it. On average, they make 9 acquisitions per year. So there you go.
All right, well, let's move on to our third stock of the day. Running a little long, but that's all right. Let's just, we're going to do Pfizer because, again, another quarterly update based on their latest numbers. And hey, Norman's joining us, which is fine. Hey, Norman, we're still in mid-shoot right now, but why don't you just stick around? We're talking about Pfizer, and just so everyone knows who's watching, this is our CFO. Maybe you can put on your IVoT background, Norman, just since we're recording this.
I don't know how to put the IVoT background on.
No worries. All right. So,
What I'll do is I'll go like this.
okay, fine. So we're on Pfizer now at this point, and just kind of, again, we try to keep the format here straightforward, right? So you can see here that Pfizer's operating cash flow in the just reported quarter grew 22%. Pretty strong. I mean, very strong from a year ago. The implied value right now is $90 per share based on cash flow, up from 73 a year ago, and compared to a $24.50 share price. So you're like, holy smokes, why is this thing so cheap? It's trading at at essentially what you call that, a 70% discount, 80% discount to its cash flow value, 75, something like that. And I'm going to talk to that in a minute because there's a really good reason why it's so cheap. Just to kind of review the basics here, again, the sales grew 10% in the quarter, very nicely. Operating margins expanded significantly based on lower sales and marketing and a slight decline in R&D spend as a percentage of sales. Pretty much flat on a dollar basis. They spend $2.5 billion a quarter on developing new drugs. So why is Pfizer so cheap? Why are you able to buy this $90 cash flow machine? Well, it goes back to what I was saying. If you buy a share of Pfizer, you own it forever. And that $90 is based on the forever value, or what you call the perpetuity value of that cash flow stream. However, if you look at those $14.5 billion in sales, here's the issue with a pharmaceutical company. They have patents. This is not like Apple with a moat around its products and people re-upping their phones every 4 years or 5 years or whatever. Pfizer's products sell until they go off patent, and then they basically go to zero. And half of Pfizer's current revenues are going off patent in the next 3 years. So that perpetuity is way overstated. Now, if you said half of the cash flow is going away in 3 years, over the next 3 years, you might say, okay, well then if I'm going to be willing to kind of deal with that and hold my nose and deal with the problems that creates from a business perspective, you might say, well, instead of 90, it's worth 45. and I'm paying 25. So there's ways to break that down and think about it. Obviously, the other thing to discuss, and I'll turn off the screen now, just go to us, is the pipeline, right? I mean, I have, as you know, Andrew, I was a professional healthcare hedge fund manager for 20 years, analyst and hedge fund manager. And that's what you have to do. You have to literally go through their pipeline and say, what do they have in the pipeline to replace half of those revenues? And that's something, again, that we can do, that you can come and join us if you're watching this on our platform, and we'll teach you how to basically evaluate Pfizer's pipeline. Again, fundamental analysis is the basic skill that we teach at IVoT, whether you're applying it to a company or actually applying it to your own financial future. We believe that that's a important skill that everyone needs to know. So any thoughts on that, Andrew? I mean, I think, you know.
Yeah. Yeah. In terms of their pipeline, I think that's quite important because, to your point, they have made a decent acquisition with Seagen, that is in the oncology area. And they're also having better than expected financial results from their Truvada or one of the drugs. And so their pipeline is actually lined up quite nicely, and that ensures them, going to all the way to 2030. And so,
Yeah, I gotta ask you though, Andrew, I'm going to play the devil's. First of all, to me, having been a professional health and pharmaceutical investor, evaluating a pipeline, as you would learn if you joined us, is not an easy task.
Yeah.
And evaluating what's in the pipeline, what's going off patent, and all of this. What's the competitive? Not only do you have to understand whether the drug is going to work or not, but you have to understand the competitive positioning of the drug in the marketplace, in the payer schemata, because you have to understand whether insurers are going to pay for it in the U.S., internationally. It's a very different issue in the U.S., where it's paid for generally by insurance companies, internationally by governments. It's a very complex.
That is still very much so up in the air.
I want to kind of push back on your evaluation of their pipeline.
Yeah.
I'm not ready to say anything qualitative. I will acknowledge that they had a cash flow boom during COVID because of just
Yes.
you could call it luck or skill, whatever, but they were in the right place at the right time, and they spent heavily on that money on buying assets. So the question, I think, is, did they effectively spend that cash flow boon on stuff that's going to show up over the next, literally, things are going to fall apart over the next 3 years. So I think at least over the next 3 years, it's not going to look good because that pipeline is not going to ramp up in time to offset the amount of product going off patent. So it's going to be like, but there can be evidence that it's going to come in and replace it. So I think, they need to see some good clinical results. I know one product failed in the most recent couple of months, but again, I had a team of PhD scientists talking to doctors, talking to scientists, talking to payers, the distribution channel when I was working on Wall Street. And honestly, my goal with IVoT is to recreate that research engine with regular people and have us as a community look at companies in the depth that I used to look at when I had my team of professionals. Also today, with the benefit of AI, in being able to kind of grab a lot of important information. I'll just say one more thing. I got to say it because this is something that bothers me about the pharmaceutical industry as a whole. The pharmaceutical industry runs these clinical studies to prove that their drugs work. And that is today the predominant science of healthcare. And the reality is that a study of a drug should not be run by the company that's going to benefit from the commercialization. That's such a bias. They design those studies to show that the drug works, not to see if it really works, but to show that it works. This is something that is known in Europe, and that's why you have to be careful, because drugs that show a good outcome in a clinical study, The German government has a very sophisticated institute just to evaluate those studies and see if they were just game to make the drug look good.
So
And
that entity should be independent, you're saying?
the clinical studies, the
Should be
pharmaceutical
independent.
companies should hand that off to
Interesting.
an
Yeah.
independent entity to evaluate the efficacy of that drug and hand back a result that both consumers, doctors, everyone can trust. What's happening? The doctors are paid literally billions of dollars by the pharmaceutical companies to run studies, to recruit the
Yeah.
right patients, to make the drugs
Makes
look
sense.
good. And
Yeah.
that's a travesty of science. So
Yeah. I have
that's
to agree with you.
my
Yeah.
statement for the moment on just the industry as a whole, biotech and pharmaceutical, and something that when I have my moment to stand for that, I will. I think it's a topic that is not discussed and it needs to be addressed.
Yeah, that's a great point that you brought. I think overall, the politics behind it needs to really beef up, in order to make any kind of change, for more true data and also for more transparency. And to your point, after the COVID profit drops for the company, for Pfizer, we can see that the stock price from 2023, a high of 47, basically almost got cut, more than half, down to 21, or low 20s. So is this a value stock or is this a value trap? So that's the question. And can the company turn around, from these low, pull back, from 47 to 21, and now it's bouncing around 24, 25. A lot of value investors look at the dividend that is paying out at, close to 7% right
Sure.
now at these stock prices. It looks like it's a value play, but, can it be sustainable? Can the revenue, be met, when promised? That is still remain to be seen. So again, very fair points that you have brought, Emile.
Yeah, and again, I would just say, to your points, it is a value stock, and at $24 with a $94 current cash flow, $90 current cash flow value, it's pricing in a lot of loss. It's pricing in 80% of its cash flow going away.
Mm-hmm.
And that's not what the numbers show. They show, I'm guessing it's showing about 50%. So that actually
Yeah.
leaves you with like 100% upside, if any of the drugs hit in the pipeline. And you got to assume, again, AI has, and the ability to evaluate drugs has improved. So hopefully in their spending spree, they were able to go and identify some pretty valuable assets, all of which are now sitting in the company, getting hopefully to get rolled out over the next couple of years. Definitely interesting company. And again, another one we could do a whole show about, not only really, we're saying not only about Pfizer, but about pharmaceutical investing as a whole. All
And
right. Well,
also, and also to your point about testing lab, there are independent testing lab that are using AI models to test drugs without using actual physical patients. And again, this will be probably one of the channels that is going to bridge a solution to what you're referring to. And again, this is part of the component that is telling us why this is the golden age of healthcare, is because of AI, robotics, and DNA sequencing. The whole revolution behind all that. That's going to help all these biotech companies to come up with more efficient ways to get results.
again, complicated topic. Early stage or more advanced early diagnostics could actually wipe out a lot of pharma industries and biotech industries, because if you catch things early, the drugs you need are a lot less potent. But again, this is my focus area from my career.
Yeah,
And
I urge the audience to respond in the comments below to take advantage of Emile's expertise here. Don't forget, he used to run a very successful monster hedge fund that is just, specialized in this particular area. So if you want to hear more about this, please go ahead, comment below, and we'll make it happen for you.
great. Well, thank you everyone for watching Eye on Investing today. You can subscribe at our YouTube channel here. And there's a link also in the description to gain early access to our platform, which includes these forecaster tools we've been using today, and which will be opening up in the very near future. Again, a subscription platform, very reasonably priced, $40 to join and get 6 months of access for all of our tools and training on how to do what we've talked about today, as well as a lot of other sophisticated financial skills that literally we believe at IVoT everyone needs in this modern global economy. All right, Andrew, have a great week. Have a wonderful time
Yes.
with your family in Asia.
Thank
And
you.
I didn't talk about Lima, but it's winter here in Peru, and we're kind of nose to the grindstone to get the product out the door here in the next couple of weeks. So take
Yep.
care, everyone.
Thank you. Thank you for your time. Take care.
Ciao.